We move on now to the U.S., where the stock index futures pointed to a higher open on Friday morning as traders anticipated robust hiring in the latest jobs report. Meanwhile, trade deficit data for April is also expected to be released at the same time. Our Friday's employment report is expected to show that gains were broad-based business and professional hiring, as well as construction and possibly manufacturing and retail, a recent area of weakness, are all expected to show improvement. Now, the all-important employment data for May has just been released in the U.S. And joining me now with instant reaction to the numbers is my colleague in New York City, Jill Maladrino. Good morning, Jill. How many jobs were created in May in the U.S.?
Well, you know what? It was a disappointing report, to be honest with you. 139,000 jobs were created in the month of May versus consensus of 185. In addition, March and April were revised lower. Now, the employment rate came in at 4.3%. That was versus consensus of 4.4%, and that was due to the participation rate moving lower. Average hourly earnings, the key to that report, came in at 0.2%. That was in line with consensus. As a result, we saw a drop in bond yields. The futures right now, they are just up about 1.5 points, so we did see a move lower on that. Now, this is going to be an important data set because it's the last significant economic signal ahead of the Fed's meeting June 13th and 14th.
Now, tell us about the June swoon.
Well, we all know sell in May and go away, but another investing meme quickly growing in popularity is the June swoon. So there's some merit to this idea. Historically, June has been a weak month for equities, and last year's Brexit sell-off is still fresh in investors' minds. In fact, since 1950, only August and September have had worse average monthly returns. Now, while over the past 10 years, only January has been down more on average. Now, here's the good news. Technicals tell a more upbeat story. This is according to Ryan Dietrich. He's the senior market strategist at LPL Financial. He says that June historically has been a weak month for equities, but the catch is some of the worst drops have taken place when the S&P 500 index was beneath its 200-day moving average to start the month. When the S&P 500 has been in a bullish trend above this long-term trend line like it is right now, June has been higher 59% of the time versus 33% when starting below.
Now, given that June 2017 will start with the S&P 500 firmly above its 200-day moving average, as you've just said, does this support the likelihood that any volatility could be a buying opportunity?
Well, that certainly has been the trend this year, but we could potentially see some volatility in June, and that's why you really need to look at the macro picture and not simply isolate the charts. Of course, there's always the overhang of what's happening in Washington, D.C., and despite all the noise, nothing has really changed with policy, and no one really has a clue what direction the White House is going, and we've done nothing with health care and tax reform. So we're essentially in an earnings vacuum until the middle of July, so the focus will really be on macro for the month of June. On June 14th, the FOMC will announce its interest rate hike decision. Right now, there's roughly an 85% chance rates will move higher according to Fed Fund futures. That might change after today's report. Then on June 16th, we also have quad witch options expiration and the S&P and Russell indices rebalance. And of course, the close of the second quarter on June 30th. So there really is a lot going on in the back half of this month.
Now, aside from the FOMC meeting, what does next week hold for the U.S. markets?
Next week's going to be relatively quiet. Again, we are out of earnings season. There is nothing major in terms of economic data on top. You will have some consumer and manufacturing data that comes through each week. But until we get into that third week of June, all eyes are really going to be on FOMC speculation. And, of course, when we have options expiration Friday on June 16th, because it is quad witch, meaning 4 different series of options will be expiring. You'll see some volume come into the market towards close. And, of course, the Russell indices and the S&P indices are going to be rebalancing. So at the close, the last 15 minutes of that session, there's going to be a lot of volume, and you could see some volatility spikes there. But next week, it's kind of a vacuum of news with the exception of what's happening in D.C.
All right, thank you very much for your time, Jill. It's been a wonderful time with you. Enjoy the rest of the day and, of course, the weekend. We'll move over now to Asia, where the markets closed in the green on Friday after the release of strong private payrolls stateside, and as President Donald Trump announced, the U.S. will be withdrawing from the Paris Climate Accord. In Asia, the Nikkei 225 jumped 1.6%. It was the first time since August 2015 that the index crossed the 20,000 mark. Australia's ASX 200 added 0.87% to end the session at 5,788.1. South Korea's benchmark Kospi index surged 1.16% to finish the session at 2,371.72. Markets in Greater China were higher. Hong Kong's Hang Seng Index rose 0.42%. Indexes on the mainland reversed earlier losses to close in the money. The Shanghai Composite gained 0.11% and the Shenzhen Composite bounced 0.846%. And oil prices dropped on Friday amid worries that U.S. President Donald Trump's decision to abandon a global climate pact could spark more crude drilling in the United States, stoking a persistent glut in global supply. Benchmark Brent crude futures were down 23 cents at $50.04 a barrel. U.S. West Texas Intermediate crude futures dropped 26 cents to $48.01 per barrel. Commodity markets were absorbing news the United States would withdraw from the landmark 2015 global agreement to fight climate change, a move that fulfilled a major campaign pledge but drew condemnation from U.S. allies. Surging U.S. production has put a strain on OPEC members' efforts to curb production to drain a global crude supply overhang and to drop up prices. A week ago, the Organization of the Petroleum Exporting Countries and some non-OPEC members met in Vienna to roll over the output cut deal to reduce 1.8 million barrels per day until the end of next March. We'll be back after this break.